What is going on, everybody? Welcome back to another YouTube video. In today's video, we're going to be looking at high probability trades versus low probability trades. We'll be taking an example of one high probability trade and one low probability trade, and we'll discuss why the higher probability trade and the lower probability trade are the way they are, and all the key aspects and elements of each trade. My apologies for interrupting the video here, guys. However, I am opening up a few spots for my one-on-one Crown Capital mentorship program. I'm only taking on a few serious traders who are willing to change their lives forever. Now, in this program, you guys will be working directly with me, where we could change, implement, and improve your trading style, strategy, or anything that you're pretty much struggling with, and help you reach that next level in your trading, whether that being getting your first ever funded account, first ever payout, or even being consistent in the markets. Now, if you guys are serious and are willing to change your lives, the link will be in the description down below. And if you guys do apply and do get accepted, we'll be talking shortly. So without further ado, let's get right into the video. So looking right in front of us here, we have an example of a pure high probability trade. And looking right here, right in front of us, we have a low probability trade. So firstly, let's look at the high probability trade setup that we see right here. Now, the first thing that I always want to see is a buy side or a sell side liquidity level getting swept. And as we can see right here, we do get this buy side liquidity level getting swept in this current example. Now, after that buy side liquidity level getting swept, I do want to see a swing low getting created. Now, as you can see right here, we do get this swing low. If I zoom in right here on NQ, we do get this swing low right there. Now, this swing low is extremely important. Without that swing low, we cannot go on to step number 3 and step number 4, which is the market structure shift and displacement. But I'll get to that in a minute. Now, let me just say, if we do not get this swing low, for example, and we get a market structure shift and a displacement, or a just massive displacement to the downside, that is going to be considered a low probability trade. We always must get the swing low in order to follow on with step number 3 and 4, the displacement and market structure shift. So as we can see right here, this market structure shift occurred and we displaced to the downside. And essentially what a market structure shift is, this swing low right here and this candle closed below this swing low. So these two are very correlated. Okay, so we get this swing low and we close below. See, this candle closes below this swing low. That is called a market structure shift. And essentially also a displacement is within that market structure shift. It is a big drop down to the downside, indicating to me that price is willing to seek lower prices. Now, before we get into the next step, I do want to look at the right hand side, which is the S&P 500. We always have to have correlating assets. Now, a key factor in order to have a high probability trade is having correlating assets. It's very, very, very important. What I mean by that is pretty much what NQ is doing, ES should be doing also. So we did sweep that buy side liquidity level, so was ES. Now, there's one thing that I want to note here is that if NQ swept that buy side liquidity level where ES didn't, that is still fine. We could still go on through the trade. Both assets do not have to sweep the same buy side or sell side liquidity level. If one asset sweep a buy side liquidity level, that is still fine. We could still carry on to the next steps. So having said that, we do get this swing low that was created on NQ right here on S&P 500, which is great. We have correlating assets. Then we also get this market structure shift and displacement on ES. Again, correlating assets. We get that on NQ. Perfect. Both assets are correlating. They're showing me good price action. There's no manipulation in this scenario right here. The reason being is because they're both doing the exact same thing. I want to see that. I want to see that price, both on NQ and ES, are both supportive of going in the same direction. Now, coming back to the trade that we see right here, we get a fair value gap. Now, this fair value gap is going to be very, very important. It's going to be a point where when price retraces into it, we're going to execute. As soon as price retraces into that fair value gap, we want to execute going short, targeting obviously these relative equal lows. Very, very massive draw on liquidity are equal lows. But this is not our point today. We're going to be talking just about high probability and low probability trades. But in general, just keep in mind that low hanging fruits are extremely important. And as you can see right here, these are relative equal lows. Very, very probable that price will come and hit it. As we can see, price does come and deliver ever so perfectly. Now, regarding our stop loss, I'm going to be placing it above this swing high right here. If price does want to continue to the downside, it should not come up and tap this swing high. Now, another factor that I do want to mention of having a high probability trade is the trade must be taken inside of the first or second AM macro. The first AM macro being from 9:45 all the way to 11:15, and the second AM macro being from 10:45 all the way to 11:15. These two 30-minute intervals is where price moves the most, and is where price seeks the key levels. So it's very important to take your trades inside of these 2 AM macros. Anything taken outside of these 2 30-minute intervals is not considered to be a higher probability trade, even though if we get a great clean setup, we cannot execute outside of these 30-minute intervals. So coming and seeing here, this is actually a low probability trade. So let's run down through this trade and actually determine why it was a low probability trade. Now, the first thing again that I want to see is a buy side liquidity level or a sell side level swept. And we actually do get that buy side liquidity level swept. It was actually London highs. Okay, so that is number 1 step on our checklist ticked off. We get that buy side liquidity level swept. Now, number 2 is I want to see a swing low. Now, if you look very, very closely here, we do get a swing low right here. If you look very closely, we get this 952 swing low, and we also get this same exact swing low on S&P 500 right here at 952. So I've marked out the swing lows right here, this one on NQ and this one on S&P 500. So the third step that I want to see and the fourth step is a market structure shift and a displacement. We look very closely to the right of it. Just after a couple of minutes, we do get that market structure shift and displacement right here. Okay, so this candle right here at 955 closes below this swing low right here. Okay, so that is market structure shift and a displacement to the downside. Okay, let's look at the right hand side and see if ES is doing the exact same thing. And as we can clearly see, that price is actually displacing and is actually creating a market structure shift to the downside at that 955 candle, closing below this swing low right here. Okay, so we do get that market structure shift and displacement. So far, so good. We got that buy side liquidity level swept. Number 2, we get that swing low created. We got that market structure shift and displacement created. Now, what's our 5th step? Our 5th step is going to be a fair value gap. Now, this is where a lot of people might get stopped out, might get tricked up. And as we can see, we actually do not get a fair value gap on NQ, but we do get a fair value gap on S&P 500. So looking at it right here, where is our fair value gap? We do not have a fair value gap. Therefore, we do not have an entry. Now, you might be looking at ES and getting a retracement into that fair value gap at 10 AM, which is inside of the first AM macro, but we do not have a fair value gap on NQ, which makes it an invalid trade. We do not have a fair value gap. We do not have even a retracement, because where are we going to retrace into? Can't even retrace into a fair value gap because obviously we do not have one. So having said that, we cannot actually execute on this trade. So it's very, very important to see and have correlating assets. So another example of an invalid trade is literally a couple minutes after this trade got stopped out. We do get this swing low right here, both on NQ and on S&P 500. And we also break market structure to the downside. Okay, so market structure shifted to the downside with a massive displacement, both on NQ and on ES. So looking at NQ here, the swing low gets broken by this candle right here. And this swing low gets broken by this candle right here. So if we draw that out in time, we get that market structure shift and displacement on both NQ and S&P 500. Now, if you look very closely, we want to obviously see a fair value gap. And hey, we do get a fair value gap on NQ right here, just before that displacement. And we also get this retracement, but it's invalid because it's obviously outside of the first AM macro at 10:22 here. That's when we get the retracement. Say we're going to enter short as soon as price retraces, have our stop loss above the nearest swing high, and target something like this. So as you can see, this is an invalid trade, obviously, because we are outside of the first AM macro, which is marked up from 9:45 all the way to 10:15. Okay, so this is an invalid trade. It is a pretty clean trade. We did sweep buy side liquidity level. Both assets are correlating this time. We get this fair value gap as well on the S&P. We get a retracement after breaking this right here, but unfortunately the retracement is at 10:22, which is outside of the first AM macro. So very important to notice when you're executing the trade, whether it's in the first or second AM macro. As I said before, price tends to see key levels in that 30-minute intervals. So there you have it, guys, a very high probability trade versus a low probability trade. Hope you guys know the difference by now and only be taking high probability trades in order to increase that win rate. Now, before I wrap it here, guys, I do want to announce the VIP Top Trading Floor Discord, where you guys are more than welcome to join, take the exact same trades as me daily. And I also do run through the trades on my Telegram channel. So if you guys do want to join the Telegram channel, the link will be in the description for both the Discord and the Telegram channel in the description down below. Having said that, I love and appreciate each and every one of you. Until the next time, peace.